it looks pretty cheap on many levels. Is this another bonkers bargain candidate, we ask? Because the shares look really, very cheap. At a 37p share price, it was only valued at 28 million quid. And its tangible net assets, those are its tangible hard net assets, are worth 32 million, and nearly half of that's in cash. So you're getting quite a lot of the business for nothing, as long as they're spending that cash wisely.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hello Lee, good to be here as always.
Yeah, absolutely. We got some news from the travel sector, or companies in the travel sector, some news from the Ultimate Stocks portfolio. We've got some UK small caps and AIM to discuss, in particular the construction area, and we've got some companies that may be about to break out through innovation, or maybe just stick to boring is best.
Yeah, no, that's interesting. Interesting conclusion there. After our innovators, we've got something that maybe isn't very innovative, but doing incredibly well.
Well, first of all, though, Chris, the Dow Jones and the S&P just at all-time highs.
Yeah, Dow Jones Industrial Average crossed the 40,000 mark, the first time in its 128-year history. Amazing. The S&P 500, the Nasdaq are also hit highs the day before. I found it interesting, the 128-year bits. And I just wondered how old the FTSE was. And that's only been around since 1984, the FTSE 100 index. Unusually, isn't it? For the United States, significantly longer heritage in its stock market. Hugely longer heritage.
Almost as old as me, Chris.
Wow.
Despite the youthful exuberance of the FTSE 100, so far this year, Chris, we've had £78 billion worth of bids for London-listed companies, according to Dealogic. That's an awful lot of interest in UK-listed companies, isn't it?
Yeah, we've had Dark Trace being acquired by private equity, International Paper is being bought as well. We've got this new deal now, Anglo-American under offer. Some are pushing back. Belgian insurer GS, meanwhile, ditched its interest in Direct Line. So some have pushed back, but loads of takeover interest, which is worrying. It's shrinking the market. And what's happened? Actually, one of our stonking small caps is now another of our companies we cover. One of our stonking small caps. These are what we think are fast-growing smaller companies. And IQGeo, the company in question, really has been fast-growing. It's now under offer from a private equity, one of the private equity giants in KKR. IQGeo provides geospatial software to the telecommunications and utility operators. So it's mapping all your area to determine where all the pipes and cables are, which helps local authorities, which helps construction of the area. It's honestly, having experienced the minefield of having had to have a gas pipe dug up and the company's not having a clue where all the pipes are, this business IQGeo has a huge market opportunity in the UK and Europe. But yeah, now it's under offer from KKR for about 330 odd million quid. So we're going to lose one of our stonking small caps.
Yeah, it's a shame, isn't it? And I was just noting as well that according to Goldman Sachs, companies in the London FTSE 100 are trading at almost 12 times earnings compared to global equities trading at closer to 17 times. Do you think that's representative of the companies, or is the London Stock Exchange actually depressed and really suffering?
I think it is somewhat depressed. There's lack of interest in it. The companies themselves, a lot of them are lower growth. You've got the banks, the mining companies, the telcos that have got weighed down. Many of these are weighed down by huge pension commitments as well, which don't go down very well with buyers and depress valuations. But then, look, London's been ticking up as well. The stock market has been ticking up. With private equity awash with cash, they're swooping on when anything looks cheap. It's really happening more, not at the FTSE 100, but at the smaller level. There are loads of smaller companies getting taken over. KKR's acquisition of IQGeo, it's the second time in a few months that they have swooped on an AIM company. They recently bought smart metering systems for just over 1.3 billion. Smart metering was an AIM company. As the name suggested, it installed smart meters, owned the smart meters, and other carbon reduction assets. It's making a habit now of picking up these businesses and making an excuse that it'll be easier for them to grow off market. It's rubbish, isn't it? Patently rubbish. The slight difference with IQGeo is its share price has really run up. it had done pretty well. The valuation actually doesn't look that cheap now. There's quite a lot of growth built into it. The premium was only about 19% to the share price before, so maybe it was up near the limit as it was. But yeah, it'll be sad to see it go. It was a really exciting business, doing really well.
To me, would be the sort of business that we would want to keep as homegrown on AIM, and who knows what it could become, but it's got global utility, hasn't it? It could Europe, America.
Well,
And
yeah, absolutely. Yeah, you got it spot on. It's growing already fast in America and in Europe with a supportive shareholder base and this patient and supportive shareholder base. This business could be substantially bigger than it is.
what do you make of Chancellor Jeremy Hunt's comments then? He said the UK can create 1 trillion of homegrown tech giants to rival Microsoft, Google, and he shrugged off foreign bids from London listed companies as just part of how capitalism works. What would you say about that to Jeremy Hunt?
I agree with that's how capitalism works. Yeah, well, look, it's a bold pitch, isn't it?
It
Clearly,
is,
he's
yeah.
ambitious. Ambition's great, but he's in cloud cuckoo land, I think. You think he's going to have a 1 trillion company? First of all, our market's not big, and our market hasn't it shrunk effectively since we're out of Europe in the short term, at least. So yeah, the US corporations are open immediately to a vast market. So there's an immediate growth accelerator there. So to think that we can develop a trillion homegrown tech giant, and he's focusing on tech, I think really is wishful thinking. I think we need to really start at the bottom here. He needs to think in the reverse. Start encouraging the smaller ones, nurturing the smaller businesses, the smaller companies on AIM, making it easier to list as well, and offering greater support, even offering greater support at the lower tax level. So from the smaller ones, you're going to develop some sort of mightier oaks, as it were, from the small acorns. And that can happen. So don't think mega to begin with. Think smaller, and you'll see what might evolve. That's what happened to AIM and the London stock market previously.
Yeah. Encourage IQGeo to stay listed,
Yeah.
and help them grow, help them develop and become a global company right here on AIM.
Yeah, because that 300 odd billion business could be easily a £1 billion business.
Yeah.
Not easily, but it could grow to that in a few years' time, and then you're potentially off to the races. Especially one like that's got international ambitions with the right backers. Yeah, I think he's living in cloud cuckoo land to develop a 1 trillion one. As you say, that's how a capitalist society works. And anything of remote interest is going to be snapped at at the moment, by a private equity, or in this case, a very large US or international listed companies.
Yeah, I do like his sentiment. He's thinking big. He's thinking global UK, large companies. I would like to see some of the details. I'd like to know how he's going to plan this and what he thinks he's going to achieve, how he's going to achieve it.
But he's meeting up with some of the big the CEOs of large companies, I think, this weekend in his country retreat.
Global CEOs or local CEOs.
I think UK listed companies, I get the impression.
Yeah.
So effectively, these are UK listed companies, effectively the majority whose operations are probably based overseas.
Yeah.
But it's going to be maybe interesting what they say. Hopefully they'll be quite forthcoming and robust in their thinking. But yeah, I don't know what's going to come out of that, but we'll see.
Do you think that meeting global CEOs of large multinational corporations is the right level of people to be meeting to help encourage small founder-led innovative companies?
I'm not convinced. So obviously, they have a very big footprint on the economy, so they're more
They
important
do,
than smaller ones. And you
how
have to
connected are they to that other end of the?
Totally disconnected. Everything about them, they're totally out of touch, I would say, with what's going on. That's the nature, isn't it, of politics? Aren't they all out of touch?
Do you know who they should invite, Chris? You and I.
Yeah, they get a down-to-earth view of things anyway.
They certainly would. They get a much better view of the landscape.
I'll be able to give chapter on verse on all the less significant, smaller quoted companies, some of which are going to go on to great things, I'm sure.
Yeah. I'm genuinely curious. Is there someone at this meeting at Country House who actually has the insight that you have of the small cap market in the UK? I don't know. Maybe
I don't know. There's the guy at the Quoted Companies Alliance, I think, is doing quite a good job. I don't know if he's going to be there. He's supposed to be representing small and mid cap companies, so don't know if he's there. Don't know if the London Stock Exchange MD is going to be there. I'm not convinced of the job she's been doing lately, but
yeah,
hopefully there might be progress.
Yeah, well, we'll see. What do you think of Shein then, as they are potentially switching focus to the UK after the IPO stalls in New York?
Well,
do you think that's a good thing or a bad thing?
First of all, whether it stalls or not, I'm not a big fan of a fast fashion retailer basically selling what amounts to a lot of cheap clothes.
Perhaps maybe that it's produced in factories that we may not approve of
Yeah, should we say somewhat ambiguous manufacturing
in practices.
practices. Yeah.
Yeah.
So, given relations between China and the US, clearly the IPO in New York is being challenging. So, essentially, they're ditching New York and being wooed by London. So, having lost a lot of great businesses, notably Arm, we're going to be welcoming Shein to the UK. Valued last time it did a funding round, it was valued at 66 billion US dollars, about 52 billion pounds. And if it does this, that would make it the 12th largest company on the UK stock market. This provider of fast fashion items, more than twice the size of Tesco, to put that into context. So a business more than twice the size of Tesco from China, manufacturing all its goods in China, but only supplying international markets. I'm not convinced.
Yeah, I don't think it's anything to be singing from the hilltops, is it? If we lose Arm, a really innovative technology company that Jeremy
Yeah.
Hunt says he wants to encourage to stay in the UK,
Yeah.
and we end up with Shein, a clothes manufacturing company from China.
Yeah, I'm not convinced. And
No.
I'm not, I think I read one comment that it would be a coup for the London Stock Exchange. Crikey. Really?
Yeah.
Yeah.
We'll move on from that topic. I
Yeah.
think the listeners get the impression of our thoughts on that.
Yeah.
For those who are listening and perhaps maybe, are enjoying the content, but perhaps maybe not into small companies as much as yourself and some of the audience as well. But Hargreaves Lansdown is launching a ready-made index portfolio of funds, which is going to actually make investing even easier and cheaper. What's your thoughts on that, Chris?
I think this is becoming really interesting for all investors. These low-cost options, easy low-cost options that quite frankly most people are going to be interested in. The vast majority of people don't want to study companies, do in-depth research on them.
Agreed, yes.
And they might be interested in what the businesses do, but they're not that bothered. They just want to make sure their savings and their investments are safe and are going to perform. The best way of performing is investing in low-cost products. Because if you look at things over the long term, the costs could really eat into your returns. And you should not be paying high fees unless you're receiving a commensurate service. So if you don't need a service, you don't need complicated financial planning, you should be basically seeking out the lowest cost products possible. And Hargreaves Lansdown are launching this new series of managed funds, and also Rival Interactive Investor are also launching low-cost products, often based around indices, flat indices. And it looks like the total cost save for a £50,000 investment, total annual cost with interactive investors is equivalent to only 0.31%. That's all in. That's all the platform fees, all the fund charges, 0.31.
Yeah.
That's really not much.
Yeah, it's cheap, isn't it? Have you seen anything whether St. James's Place are offering something similar?
No, I haven't seen that yet. I think it might challenge their business model. I did. But you make a great point. Going forward, what is the future going to be for many of the financial advisor community, much of the financial advisor community? How are they going to make a return? This move to low-cost products that for the cost of a nice evening or two, a nice lunch, imagine how much people are going to save in these cheaper products. They'll be able to go out for a holiday. They're going to pay for holidays, not just a lunch, on the sort of savings these things will bring.
Well, actually, that's a good segue you mentioning holidays there, because the next bit of news is coming from the travel industry, and we've got mixed reports coming from TUI and On the Beach, haven't we?
Yeah, I thought it was odd. We covered the travel sector a bit, and TUI reported its winter booking season ended strongly, seems to be doing well, promising momentum for its upcoming season. In price hikes haven't apparently putting off holidaymakers. TUI, it's got its own airline, hasn't it, as well? It's an integrated travel offering. And we've seen recent data from BRCK for April showed that although overall retail spending dipped, transactions at the travel agents soared. Again, positive. Just had also results from EasyJet that also commented on positive summer demand. EasyJet is also trying to grow its travel offering. But then on the same time, we have On the Beach Group, which advertises heavily, isn't it, on TV, has commented while its premium market continues to perform, it's the value market, it's at the lower end, remains more challenging. So I don't know, but a few mixed messages in there. Is this a problem on the beaches and not necessarily the same? These other companies aren't experiencing similar issues.
Yeah, and doesn't Jet2 operate at that kind of end of the market as well.
Yeah, well, Jet2 very much, and has been seemingly doing pretty well
Doing,
as well.
yeah,
And TUI as well operates at that end. It has an extensive offering, as does EasyJet.
yeah,
So
absolutely, yeah, absolutely,
I
yeah.
I find it's a bit puzzling. On the beach shares took a real nosedive as a result of that comment. But yeah, it's an odd one. On the beach is clearly an agent, doesn't control the airline bit for argument's sake, as these other groups do.
Yeah, so perhaps maybe it's more a on the beach issue as opposed to an actual market issue,
Yeah,
perhaps.
perhaps. Yeah.
Should we move on to one of the ultimate stocks portfolio? Experian jumps to new high as full year tops expectations.
Yeah, it's great business. This is one of our ultimate stocks, a constituent of our ultimate stocks portfolio, and our fundamental asset management, our associated investment management business owns these shares. Experian, the data services, credit rating agencies, going great guns. I think the interesting thing about this, we won't delve into too much detail of this business. It makes great margins, great cash flow. It's growing quite nicely, not rocketing, but growing high single digits growth. So look, it's all doing really nicely, investing a lot in as well in data centers and AI. But the interesting thing, this Experian is listed on the UK stock market. It's a UK listed company. However, 66% of its revenues come from North America. Its shares are quite highly rated. They're not cheap. Could this be another business might be tempted to change its listing
Yeah.
to the US? Would it get a better rating out there? I'm not so sure because, as I say, it seems to be doing fine on London. But yeah, it's doing really well.
Yeah, so hopefully Jeremy Hunt will encourage a company like that to stay.
I hope so. We need more like that. Yeah.
Yeah. How long have you held it in your portfolios?
I think about 6 months now, probably.
In both the
Yeah, it hasn't been in that long, but yeah, we've had about 6 months, a bit longer, I think. Yeah.
what was it that initially attracted you to it?
We needed a replacement. We were moving out of one stock. We wanted a replacement. We wanted to, at basic levels, we wanted to retain the UK market exposure. We thought there was good value there. Experian shares, we didn't think they were pricey, but it ticked a lot of the quality boxes that we look for in our ultimate stocks portfolios. Nice margins, operating margins, 20% plus, sorry. Great cash flow, great return on capital. We like the rollout, that the model, the AI piece, the data gathering as well, and the cost efficient nature of the data gathering. Yeah, it ticked a lot of boxes for us. As I say, the valuation relative to the US peers we were looking at wasn't stratospheric. It was fair, and and as a result, we went for it.
It's starting to grow quite well in Latin America as well, isn't it?
That was the other piece that we liked. Clearly the North American exposure was great, but it was evidently still in its infancy in Latin America, which offered a big opportunity.
Shall we then move on to something that perhaps a little bit smaller than
Yep.
an Experian?
Yeah.
We come down the chain to the UK small caps to Brickability, which is a company that you also hold as well in your portfolios.
Yep, we like Brickability. It's a construction materials distributor. At its heart, it was a brick distributor. But I think this is all part of the theme that for the UK economy, we firmly believe that all things positive start with construction. If the construction sector kicks back into life, that's going to feed down into everything. And Brickability, I thought, has been really interesting because we saw one of their managing director of their contracting division. I don't think he's main board, but he's picked up a heap of shares, £377,000 in value of shares, built that up to, I think, over £500,000 in total of share purchases, buying shares in the company. And this is followed up that the departing CEO of Brickability, the gentleman is retiring, has also acquired more than £1 million worth of shares in the business
Oh,
a few
that's
months
interesting.
earlier.
Yeah.
You never see a retiring CEO buy that many shares. Look, he's
They're
a big
normally
holder.
selling.
He's the founder of the company. Yeah, they're normally exactly.
Yeah.
They're normally selling, and directors are often really canny buyers. So is this a good sign that we've reached the sort of trough of the cycle, that it's onwards and upwards here? Are things going to start looking up? Perhaps. Look to the construction sector. I think it's a really good barometer for the UK economy, and it can be for the UK stock market.
Yeah. What's the saying? Follow the money. If the directors are buying shares in pretty decent amounts, then
Spot on, spot on. In the same sector, we had Michelmersh Brick Holdings, which is one of our bonkers bargain opportunities. We think the shares are super cheap. That's why we call it a bonkers bargain. We also hold the shares in our fundamental AIM high income portfolio. It put out a reassuring update. Michelmersh has got loads. It's a brick manufacturer, specialist brick manufacturer, one of only 3 in the UK now. three core sort of three sort of four dominate the market, and it's doing really well. It's got a great balance sheet, net cash, buying back shares, nice dividend income, about 4.5%. So again, it's reassured that things aren't too bad. From the same sector, we had another business called Lords, which is struggling a bit. Lords is also a distributor of building materials. Lords has been built up through acquisitions, so it's slightly different to Michelmersh, which is more organic growth. But yeah, Lord is been struggling. What struck me with this is, first of all, it's 450 million of revenue, and you don't end up with much profit at the end. So this business is having to pedal very hard just simply to stand still at the moment. But what slightly put us off with Lords is it's running very high amounts of debt. The sector that it's operating is really challenging, and it's making quite a lot of acquisitions. And its debt is very expensive, but it's still paying out a dividend. We would suggest it would be better to hold back with the dividend, because it is, whether it's paid out or not, it's still the shareholders' money that's being consumed by high interest rates. But it's determined to pay out this dividend. Which if you look into the detail, this dividend is really being paid out of debt, which is never a good idea from our perspective.
Is this more of a company then to perhaps, I'm not going to say it's a red flag, far from it, but it's a company just to be aware of, that things are not quite as rosy under the surface?
I think I think the point of effective use of cash, the effective management of capital, when you've got only limited access to limited amounts of capital, you need to spend it wisely. And paying out a dividend, which, would you buy this share as a dividend stock? I'm not convinced, really, given the nature of it, given the uncertainty of its dividends. Why pay out the dividend? I don't know if certain shareholders, maybe the founder likes dividend a lot, maybe certain shareholders demand a dividend, but quite frankly, I wouldn't be bothered. The other problem is they quote the dividend is covered 2.2 times by adjusted earnings per share. It's not covered 2.2 times by free cash flow. It's not actually covered. So again, a red flag to people. When companies say their dividend's covered by earnings, make sure it's also covered by free cash flow, because a dividend is paid out as cash, and the cash being received, the incoming cash, has to cover your outgoing cash. Earnings are just full of provisions and estimates and all sorts of accounting adjustments. They're practically worthless in terms of the dividend cover.
Yeah, so they're using choice words to mask over how they're actually funding this dividend.
Yeah. And it was pertinent that they said that the dividend is 2.2 covered by earnings. And they made that statement. If they wanted to impress us and say it's covered, they could have told us it's covered by free cash flow.
And that's far more powerful, isn't it, than
free cash flow is the most powerful. And surprise, surprise, few companies mention free cash flow.
And as you've mentioned multiple times, that's one of your key tick in the boxes, isn't it?
Should be anybody looking at a business. At the end of the day, it's only as good as the cash that it produced. Who cares about these flashy earnings, especially they're adjusted to smithereens?
What do you think about Angling Direct then? How's their free cash flow?
I thought this was an interesting little business. It's unusual. There were two angling businesses on AIM at one point, angling retailers. These are supplying fishing tackle and equipment to the coarse fishing sector primarily, not fly fishing, so the coarse fishing area. And Angling Direct. There was another one called Angling Republic, I think. That went bust, didn't do very well. So it's not a good sign. But Angling Direct reported this week. It's still quite small. Its revenue was up 10% in the year to 81 million quid, just over 81 million quid. Record UK sales of 77 million. It's also, bizarrely though, it's deciding to grow in Europe. So it's only got 40 odd stores in the UK, but it's strangely decided to go and start expanding in Europe. I'm not quite sure why. And it's hemorrhaging money in Europe in the short term. It's making losses. But 47 sites in the UK. Why? I would have thought there'd be a lot more to go for if they were really trying to dominate the market. But it looks pretty cheap on many levels. Is this another bonkers bargain candidate, we ask? Because the shares look really, very cheap. At the 37p share price, it was only valued at 28 million quid, and its tangible net assets, those are its tangible hard net assets, are worth 32 million, and nearly half of that's in cash. So you're getting quite a lot of the business for nothing, as long as they're spending that cash wisely. That's the issue, and it is generating free cash flow. Go back to your point. While profits were low, actually free cash flow was pretty good. But it's this European expansion is a strange for us. But the other thing I thought was worth looking at, how big is the coarse fishing market. Apparently, freshwater anglers contribute an estimated 1.4 billion annually to the English economy. This was an environment study, 2018. So that's quite a lot, 1.4 billion. However, anglers each spend on average just over £400 on tackle and around £110 on club or syndicate fees. Now, those amounts didn't sound so much. So this is a bit of a numbers game. And there are quite a few anglers, but each of them probably aren't spending vast amounts compared to, say, other sports. Other sports, they spend an awful lot of money, don't they?
Have you an indication of why they're expanding into France? When you've looked into this company, was there an indication of why they've chose to? Is it because it's a bigger market in per capita? But
I don't
say
know.
£400, is it double that, triple that?
Maybe, I don't know. It's not actually France. Their first European outlet is in the Netherlands, I think.
Right.
Utrecht in the Netherlands. Just one. Generally speaking, you can only start getting to scale when you have a sort of cluster, can't you? It's hard to support one outlet. Clearly, they're selling online in Europe as well, which is, they're probably getting an indication. But yeah, I've got no idea what the
So they
European
haven't given
size
indication of why they've decided, instead of opening another in a potentially prime spot in the UK, they've opted for, as you say, Netherlands there.
Well, that's the point, isn't it? Going back to what is the most efficient use of cash?
Capital, yeah.
Yeah, and capital. Where can you bet the biggest bang for your buck? And I would have thought there's plenty to go after in the UK rather than going overseas, which is harder to support. But maybe they have their reasons. But are all the shareholders happy with this move? Who knows? But thankfully, they're in great cash position, generating cash. We would implore them not to squander that cash.
Yeah, one to keep an eye on.
It'd be nice to get some, as you've suggested, some rationale behind the European foray.
Expansion.
Yeah.
Should we finish the episode off then with a couple of companies where innovation is quite high and they're quite interesting companies? And then we'll contrast that with a company that is not very innovative, quite boring, but it's a company that you've been an investor of for 15 years, did you say?
No, yeah, not quite as long as that. Not quite as long as that. But yeah, we've been in there for a while now.
Been in there for a while. And that's Renew. We'll come on to Renew. But before we get there, there's a couple of companies that are quite innovative.
They're both very different. So one's called Zotefoams. It's on the main London Stock Exchange. It's been around, apparently, traces its roots back to 1921, the original business. So it's a 100-year-old plus company. And Zotefoams is a world leader in cellular materials technology. Their foams go into all sorts of industrial products. They go into aeroplanes as well. Lightweight, very strong. Anyway, they've developed something fully recyclable mono-material barrier packaging substrate for beverage cartons nowadays currently aren't fully recyclable. They've developed something that is. So this 100-plus-year-old company, which is profitable, cash generative, it's worth about 230 million pounds at the moment, has got this suddenly innovative new product that they've been spending a lot of money developing, but that's all being supported by its existing operations. That's the interesting thing here. So the innovation is being funded through existing cash flow from legacy profitable cash generative operations. But yeah, they could be, look, if they can get a buy and they're working with a big beverage bottle, a private beverage bottle called Refresco, if this works, they could be really fly.
Yeah.
It's tough. A lot of people are going to be evidently exploring recyclable cartons.
Absolutely.
They're not going to be the only ones. But yeah, they've got a great chance. And the valuation's not crazy, I don't think, given the upside potential of this innovation. But yeah, an interesting one. That's an interesting one, I think.
One to look into, one to keep an eye on. And the next one's Creo Medical.
Yeah, now this is a newer AIM company. It's only been around since like 2003 when it was established. We didn't have anything. We just had an idea back then. But this is in a medical device company in the emerging field of surgical endoscopy. And it's got highly innovative, addressing a potentially huge market. But unlike Zotefoams, it's an AIM company. It hasn't got any legacy profitable cash businesses to help fund its innovation. It's having to go back to shareholders all the time to support it. But it looks like it's doing something really valuable. We've written about it on Investors Champion. You can read more about it there. It's had studies with an NHS supply chain study highlighted the massive savings that it could be made for the NHS using their technology, not just cost savings, but in terms of life savings as well. And it's still, a lot of its products are in their infancy, but it seems to be proven. It's now a matter of commercializing it, selling it, getting the take up. And it's very hard to break into a market like this, which is full of big, cash-rich, reputable, credible, blue-chip incumbents. They're not going to want to cede market share to a newcomer like this. But up to now, it's the sales from its core products are modest. They're only 2 and a bit million in the 12 months for its core products. But the potential is to be, tens, hundreds of millions revenue and huge margins from it, because it's a lot of the value is in the intellectual property. But yeah, to conclude, to emphasize the difficulty compared to Zotefoams, poor old Creo Medical has cumulative losses of 144 million.
Wow.
So it's sunk 144 million into this, and shareholders have had to pony up to now 180 million of equity capital, which is only now worth, the market capitalization of the business is only 115 million. They're staring big losses. It's a case of you have to be very patient. If it's on a public market, the stock market, shareholders have to be really patient, because you're going to go through some big dips probably until things can really start flying. If they ever do, this thing could never get going. That's the risk.
Yeah. Are they getting close to being able to really scale up?
It seems to me they have the products. They've bought effectively some distributors. They've got the sales channel. I think it's now a matter of getting the buy-in from the surgeons, the specialists, to embrace this. The specialist is obviously happy with whatever they're using. So it's got to be proven to be significantly more beneficial for them to use their product, which is, as I said, really tough.
Yeah. Obviously, I'm not as well versed in the medical arena for private companies, but how has it took them so long to execute the actual development and production of that idea?
I think it's the nature of the beast. You go through initial product testing, it doesn't work.
Is it just that long in the medical arena?
You do
it
it
takes
again.
that much time.
Yeah, and you got to then it's expensive to get clearances, the FDA clearances and all the other clearances you need is pretty costly. They do have FDA clearance now, and they have European clearance as well, which is, I think, taking a bit longer than anticipated. But I think they've done a lot of the hard work. But often the hardest work of all is the commercialization, the selling bit. Yeah. Everybody ignores the selling bit, but that's often the toughest. To sell things is really tough, and to get other people to buy it is very tough.
And is there indications that they're starting to get the selling part?
Yeah, but small stage.
Just small steps.
2 million, pretty minuscule, isn't it? But hopefully they'll get there. If it's good, it'd be great. Another great innovative company that we should be supporting. But it's a very tough one for stock market investors to run with. Or even if it wasn't on the stock market, even if it was a privately funded or VC funded, you've got to have these years and years of patience and trials and tests, and then commercialization patience. You've got to wait a long time to reap the rewards.
Yeah, I mean, I think it was part of timing, and it was probably more timing than anything. But the US, when the whole tech bubble and the internet, the birth of the internet, they were just really well placed for a moment in time that allowed them to innovate with very little regulation. Tech companies are not bound by the same restrictions that banks are, even mining companies. And these are the biggest companies on the UK.
Or medical.
Medical. Yeah. So we can have some of the most innovative medical companies in the world right here in the UK. And because of the regulations that they have to deal with, it takes a lot longer than for a US company to develop an app.
Yeah, absolutely. Yeah.
And be at scale within a year or two.
But once you do, if you do get up to scale, and once you get embedded
it's a massive
in
barrier to entry.
Yeah, which is exactly the problem that Creo's coming up against, because it's coming up against the strikers of this world who are fully embedded in the marketplace. But the rewards are huge, but wow, it's a tough old road.
You see companies like this that are trying to break in, trying to bring something innovative to the market. And then you look at Facebook and you look at Instagram, you think, all right, what value have you actually added to the world? Probably not, probably actually negative, where these companies here are struggling. They're trying to make a positive impact on people's health, life, longevity. But we praise Facebook, we praise all the big tech giants, but it's debatable, isn't it, the value they've actually brought to humanity?
You're absolutely spot on. It's trying to do great things, this little business, potentially great things.
Potentially,
Yeah, and it's far more of a struggle because of regulation. Clearly, if it gets it wrong, it can kill people.
Of course,
so it's a bit more sensitive. So
I know
it
it's
does
a
need
balance.
Regulation.
Yeah,
but
and it's not something we're going to fix here either, is it? But I just thought
it'd be lovely to have a better mechanism that these sort of things are supported, because they're going to take a long time.
Yeah,
and it would be great if they could get more support.
But so anyway, should we move on to company that's been around a long time and a company you've been invested in for many years, as you've mentioned, Renew. And this company is not very innovative, but it's doing really well, isn't it?
Yeah, look, this is the type of business that we were actually a bit wary of for a long time, and we didn't leap in immediately, and we looked at it a lot. It's an engineering services group.
Sorry, when you looked, you're talking way back when you looked at
Yeah,
this.
when we started looking at it a long time ago. Sorry, we haven't held it for that long in our AIM book. We've been holding it for a few years, but way back we looked at it when it was much, much smaller. We looked at it and we were concerned. It was really comparing it with our ultimate stocks portfolio, the sort of companies we like. It was the polar opposite. This business really, in many respects, has a lot of red flags at the time. Tiny margins, huge turnover, engineering services group, it had a lot, and a tiny balance sheet. So the risk is our short-term view of it was, wow, if it messes up on a contract, on one of these big contracts, it's basically gone. That is the risk. And I think we've mentioned before a certain business called, what was it, the UK listed company, Carillion, which folded, which was involved in mega contracts, got its pricing wrong. Everything was wrong with Carillion, but it blew up. You can see with engineering services how it can go badly wrong. If you're involved in very big capital schemes, it can go badly wrong. Renew isn't like that. Most of its contracts are maintenance and renewal schemes. It's not involved in big capital contracts. These are small, controllable, ongoing frameworks that it's involved with in the rail sector, water, and all the general utilities, and it's in the nuclear as well. So it's really a support business that evidently does things really well. Now, its margins have actually grown. So this thing initially was about 2-3% net margin. Now it's 5%, 5.5% margin. So they've been ticking up all the time, and it manages its capital really well. It generates lots of cash, and it's used that cash to make little bolt-on acquisitions of other engineering services business, which is plugged into its way of working, and maybe areas that it needs to be filled in. So it's just really impressive. Free cash flow has been really good, and it's a massive beneficiary of UK government spend. There's talk of 600 billion over the next 5 years to meet the target of net zero carbon emissions. So you can have loads of investment in nuclear and green energy, and these guys are going to be around supporting it all. And with pressure on public expenditure, they're seeing increased funding towards maintenance. Again, that's right in these guys' sweet spot. Network Rail's commitment, 32 billion on renewals and maintenance. Again, right in their sweet spot. And you've got a nice order book offering decent visibility, and it just ticks along, upwards and onwards. Shares don't look that cheap. I think it's proven itself.
So clearly this is a company you're still happy with, and perhaps maybe not moving out of the portfolio too soon. But I'm just curious, what would be the red flags for you to start to think, oh, hang on a minute, are we heading down the road of Carillion here? Maybe not become Carillion, but the mistakes that Carillion made.
I think you've got to look at those margins all the time. And as I say, they've been ticking up, and you look at the cash flow or any payment issues. You look at the industry news as well. Have there been any major foul ups? Where is the major contract exposure? It seems very well spread. It's just lots of, dare I say it, boring work. That it does seemingly quite well. It doesn't lose its clients. It maintains relationships with them over the long term, and clearly very good management. I think if you look at the margin issue, is key on this. If you see that ticking down significantly, that's going to be evidently an issue.
Yeah. So sometimes maybe boring is best.
Yeah, it's just the way.
Should we leave it there then on that bombshell?
Yeah, that's probably good. Leave it at the boring bombshell.
Boring is best. We'll leave it on that. Thanks, Chris. Again, some great insights.
Always fun.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics, and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.